Hello everyone from Behavior Analysis. This is Martin Rosenthal, the financial advisor for your 401k, and we have some life-changing information we wanted to share with you. All right, so stay tuned. Let's take a look at a few important money principles that once you understand them will absolutely make a gigantic difference in your life. A rule in finance that's really good to understand. It's called the Rule of 72. I don't know if you've heard of it before, but let me try to explain the concept. And again, it goes to compounding interest. You take the number 72, which is a magical number in finance, and you divide the rate of return your investments are either getting or you hope to get. So let's use like a bank, a savings account. Now, right now, the rates are very, very low, but to be fair, to that type of investment, the long-term average for a bank savings account is around 3%, even though now it's less than a half of 1%. But let's use 3% and see how this rule applies. So 3 divides into 72 24 times. What does that number 24 tell us? It tells us how long it takes to double your money. So if someone had $10,000 in a savings account and it averaged 3% per year, over 24 years, your 10,000 would turn into 20,000. So that's the rule of 72. Now, how does that make a big difference? Let's say someone is averaging 9% in their investments, not in a bank investment, but rather some sort of stock market or bond or other types of investments which have the potential to earn more. So let's use the number 9. 9 divides into 72 8 times. What does that tell us? That in 8 years, our money will double. So a $10,000 investment that averaged 9%, at the end of the 8th year, the 10,000 would turn into 20,000. So let's just play along with this for just a little bit and go back to that bank investment. It took 24 years to double, while an investment at 9% doubles in 8. In fact, over the same time period, 24 years, it would have a chance to not only double once, but twice, but 3 times. So during that same time period that the person in the bank was waiting for their $10,000 to grow to 20, a person who was investing in other types of investments with higher potential, the 10,000 would turn to 20 in the 8th year, and in the 16th year it would turn to 40, and another 8 years it would turn from 40 to 80. In the same time frame, 10 turned to 20 in an investment making 3%. At 9%, it turned to $80,000. A super important principle to remember. Now let's take a look at how time and compounding work together. The first principle we want to look at is time. The younger you start putting away money for your future, the more years in front of you it has to compound. We want to take a look at what Albert Einstein reportedly said about the magic of compounded interest. In this example, the top of the chart shows simple interest. And in this hypothetical example, someone has $1,000 and they are earning 10% interest each year. So 10% of the $1,000 in year one, $100 was earned. And in this example, the person either took it out and spent it or did something else with it. Year after year, you can see for the first 10 years, $100 was earned off the original $1,000. So 10 years of $100, if someone was simply putting the interest in their pocket or under their pillow or in a bank account that wasn't paying anything, it would take 10 years to double your money from $1,000 to $2,000. But now let's look at the compound interest formula, and that is instead of taking the money and spending it, taking the interest that was earned in year one and taking that $100 and adding it to the original $1,000, and then going into year two, your 10% earnings are not just off of the $1,000, but they're off of a $1,100 investment. And then year two, you earn $110 of interest. And that interest is then reinvested back into the 1,100. And you can see as you go across the chart, the 10% of the higher value each year earns us a larger amount, to the point that in the 7th year, not in the 10th, in the 7th year, If we reinvested our interest, that's how we get compounding, by putting it back into the investment. By reinvesting it, in a little over 7 years and just a few months, our 1,000 would have grown to 2,000, almost 3 years quicker than if we had not put it back into the original investment. In fact, by compounding at the end of the 10 years, instead of having $2,000 as the example shows in the top of the chart, we would have $2,593. Quite a bit more, over 25% more. And this is in the first 10 years. What happens is year after year, with time on our side, the compounding absolutely works miracles for us. While the younger you are, you have time on your side. I want to throw this out there as well for those who may watch this who are not in their early 20s or in their early 30s. It's never too late to start. And although starting earlier gives you an advantage, some people react to learning these principles and say, oh, I should have started earlier in my life. It's too late now. When's the best time to invest? Whenever you have money and you have a little time in front of you. But again, the earlier you start, the better. Now let's take a look at this chart that shows a very simple example of how compound interest works and why it's to our advantage to use it. In this example, we're going to look at two twins, Jane and John, both 25 years old. Now, if they look a little familiar, it's because they happen to come from a prehistoric family, the Flintstones and the Rubbles, but we'll skip over that and just call them Jane and John. So they're both 25 years old and they both have 401ks available to them. Jane starts to put away $100 a month into her 401k, but John is busy saving up for a car, and he also has some other expenses to save up for. So he says, you know what, I'll wait a year or two and then get started. But in this example, Jane funds her 401k every single month with $100 for 40 years. She works from age 25 to 65. She never, in this example, she never increases her contribution, which hopefully over time we all will. But let's say she keeps steady at $100 a month, and she has a very good return of 12%. Now, that's not a return that we think everyone should bank on, but historically, over long stretches of time in the stock market, that is an achievable goal, especially over the long term. But let's pretend in this example, she averages 12%. At the end of 40 years, she has a little over $1,170,000. She was putting in $1,200 a year for 40 years. That means she put in $48,000 total into her 401k, and it grew to almost $1.2 million, $1,170,000. Her brother John, though, he didn't start his 401k in his mid-20s. A lot was going on, and he felt he couldn't spare the extra $100. In his 30s, he had young kids and felt that he had to save for college for them. So he kept putting it off, and we're not saying that he was a terrible guy. Life got in its way, though, and he didn't make the $100 a month a priority. By the time he was in his 40s, he said, uh-oh, I'm really behind, but I'm going to wait until I get closer to retirement. By the time he was in his 50s, he realized that time had snuck up on him and that he should get very busy. So he knew that Jane had put away $100 a year, $100 a month for 40 years. So he said, how much can I afford to put away? He decided, you know what? Finally, I can put away a decent amount of money. I'm going to catch up to my sister. I need to play catch up. So he put away $1,000 a month, not $100, but $1,000 a month, trying to make his nest egg grow as large as possible. He did this for 10 years. So he put away $12,000 a year for 10 years. So he put away $120,000, which is a lot more than his sister had put away, but his account had only grown to $230,000. The reason for the large difference in account values between Jane and her brother John is the long amount of time that she had for her account to compound. Compounding is similar to a snowball rolling down a hill, getting larger and larger over time. While we don't expect you to have an MBA or earn a PhD in economics before you can invest in your 401k plan, we know you're all busy with school and work, we do want you to have a better understanding of some of the investments that are offered to you, and so that you'll do a better job of selecting which is most appropriate for you. We have noticed that a lot of you are using the money market fund. Now, we're not saying you shouldn't have any monies in there, but if you have a long time period in front of you, the money market fund is really just like a savings account. And though it can't drop down in value, for those who have many, many years in front of you before you hit retirement age, you should think twice before putting too much money into the money market. So hopefully these next charts will help you be a little better informed in making your selections. This next chart we're going to look at shows you the different investment options that are available to you inside of your 401k. Let's take a look at the bottom left-hand side of the chart. Here we see the money market, and as we go to the right on the chart, we expect a greater potential return, while going to the left is a lower potential return, and the same thing going from the bottom up, more conservative up to more aggressive. So you can see there's a variety of individual investments you can choose from: Vanguard Money Market, Vanguard Short-Term Bond Index, Total Bond Market, and working your way up. The first several are bond investments, and then we get to U.S. stock market investments, the S&P 500, and then we have additional Vanguard Value Index, Growth Index, and as we're going up, you should see, if you take a look at these investments, that the return is potentially greater, but the volatility is as well, and you need to understand that. And you just don't want to look at a short 1 or 2 year period for returns. You want to look at these things, how they've performed over different time periods. We also want to encourage you, unless you really want to spend the time in looking at each of these individual, we feel a more simplified way of getting into these investments, and that is using some of the models that we have available for you. Let's take a look at the next chart. In the next chart, we're going to show you how we've taken those individual investments that are, again, available to you, but how we've packaged them or put them together in what we call different models. So looking at the bottom left, we have the conservative model, and you see the number 20/80. 20 means that's how much of the investment model is put into the stock market and real estate investments, and the remaining balance, the 80, is invested in cash and bond investments. That's your model 20/80. That's the most conservative model. Going up, we have the moderate conservative model, which is a mixture of 40% stock market real estate, 60% bonds, and then the next middle model we call the balanced model. That is 60% stock market, 40% bonds. The next highest is the moderate aggressive, which is 80% stock market, 20% bonds. And then we have the aggressive model, which is 100% stock market and 0% in bonds. So you should give some thought as to which of these is most appropriate for you. And we actually do have a software that if you answer a handful of questions, it can help determine what might be the best model for you. Now, the younger you are, typically the more aggressive you can stand to be. And as we've shown in some of the previous charts, even though it's more aggressive, some of these models, the long-term potential return is a lot greater. And if you're investing 20, 30, or 40 years, you should see the difference that that higher rate of return can make. It can literally make hundreds of thousands, if not even millions of dollars difference for a person investing more aggressively versus more conservatively. What you do have to do, though, is make sure you're aware of the potential volatility of the investments you're in, and train yourself or teach yourself or educate yourself on how to deal with some of that volatility. Also on this chart, we have two other types of models, but they're not fixed models. Those are the Vanguard Target Retirement 2040 and the Vanguard Target Retirement 2050. What those are is you would take, those are called target date funds. You would take the approximate year in which you'd be in your late 50s or 60s, or when you think you might want to retire, and those funds once you invest in them, they would gradually become more conservative the closer you get to that target date. The other models, they stay, let's say we use the moderate aggressive model, which is 80-20. That model is 80-20 and will stay 80-20. Periodically, we rebalance it back to 80-20. If you're in that fund for 20 or 30 years, it would still maintain that 80-20 mix. If you were to use one of the Vanguard target date funds, over the years they would gradually become more conservative as you're getting closer to your target date or your retirement date. Now, when we say conservative, you don't want to be 100% cash or bonds at retirement, because if you retire in your late 50s or 60s, you still, hopefully, God willing, have 20 or 30 years or a long period of time to still be an investor. So you still need to be invested and have some stock market exposure. We hope some of the information we shared with you today was beneficial. We wanted to end up with a few final thoughts. First of all, to behavior analysis, I want to say thanks so much for setting up this 401k. You've set it up as a tool for your employees and participants to help them with their financial future. You know, it's optional for employers to offer retirement plans. They're expensive, they take time and effort, bookkeeping, especially when a company like Behavior Analysis they distribute some profits from operations. That's an optional thing that they do to employees, and it's a really nice thank you and to show their appreciation for your hard work. So I just wanted to give them kudos and for doing such a good job with that. So don't forget, we're here to help however we can. Our company name is Common Sense Wealth Management, and we're the advisors for the 401k. Please let us know if there's any way we can assist you. This was just a brief overview of how 401ks operate, but you might have a lot of other questions. There's plenty of resources out there. You can always call us, email us. Our email address is ccwealth@gmail.com. Our office number, as well as text line, is 954-769-0837, and our website is cc-wealth.com. We wish you the very best, and please let us know how we can assist. Take care.